Here's something that should make you uncomfortable. The S&P 500 gained 25% in 2024, then 18% in 2025, two of the strongest back-to-back years the market has seen in decades. And right now, with inflation back above 4%, unemployment creeping towards stress territory, energy prices surging on a war in the Middle East, and the market's CAPE ratio, a measure of how expensive stocks are relative to earnings, sitting at 39.8, one of the highest readings in history. 76% of American investors say they're worried about a downturn this year, and nearly half say they're completely unprepared for one.
Here's the problem. Being worried and being prepared are two completely different things. Worried people check their portfolio obsessively and panic sell at the worst possible moment. Prepared people have a specific playbook they follow before, during, and after a crash, and they come out the other side with more wealth than they went in with, not less. Today, I'm giving you that playbook, step by step in the exact order it needs to happen. My name's Eric, and I spend way too much time thinking about money, market history, and why most people make exactly the wrong moves when markets get scary. If you want a clear, step-by-step game plan for what to do with your money before, during, and after a market crash, subscribe and give this a thumbs up. Let's get into it.
Let me be direct about something first. Nobody, not Goldman Sachs, not the Federal Reserve, not any analyst on television, can tell you with certainty that a crash is coming in 2026. What the data does tell us is that the conditions for elevated volatility are clearly present. The New York Fed's recession model sits at 20.7%. The OECD cut its 2026 global growth forecast to 2.9%. Unemployment is at 4.4%. Stable, but close enough to the stress threshold that Goldman Sachs now sees it potentially rising to 4.6% under an oil shock scenario. The CAPE ratio sits at 39.8, and the Buffett indicator, total market cap as a percentage of GDP, is above 200%. Both are historically extreme readings that have preceded major corrections.
76% of American investors are concerned about a potential downturn. Nearly half say they are unprepared for a recession, a figure that rises to 54% among those earning under $75,000. Here's what history tells us clearly. The S&P 500 has never produced a negative total return over any rolling 20-year period. Every crash in history has been temporary, but the people who come out ahead aren't the ones who predicted the crash. They're the ones who had a plan before it started. This video is that plan.
Step 1. Build your emergency fund first, before you think about anything else in the market. This is the step most people skip because it feels boring, but it is the single most important thing you can do to survive a market downturn with your investments intact. Here's why. When markets fall and you don't have cash reserves, one of two disasters happens. Either you sell your investments at the worst possible time to cover an emergency, locking in losses permanently. Or you rack up high-interest debt to cover expenses, which compounds against you while the market recovers without you. Your 401k balance can temporarily decline during a crash. You only realize losses if you sell. The only thing that forces you to sell at the bottom is not having cash anywhere else. A 3 to 6 month emergency fund isn't just a financial safety net. It's the thing that keeps your investment strategy intact when everything around you looks terrifying. Step 2. Know what you actually own and whether it matches your real risk tolerance. Most people don't actually know what their portfolio looks like. They set up a 401k 10 years ago, clicked some allocation they vaguely remember, and haven't looked since. Before a crash is the time to find out whether what you own aligns with how you'll actually behave when your balance drops 20%, 30%, or 40%.
In the 2022 bear market, concentrated portfolios were hit hardest. Investors who were over-leveraged in single-sector tech portfolios saw their wealth evaporate, while those with diversified defensive holdings in utilities and healthcare survived the storm. Log into your brokerage account right now, this week, and answer 3 questions. What percentage of my portfolio is in stocks versus bonds and cash?
Am I concentrated in one sector, specifically tech, given that AI investment alone is expected to drive 40% of S&P 500 earnings growth in 2026, making it the most crowded and therefore most vulnerable trade in the market? And honestly, if my balance dropped 35% tomorrow, would I hold or would I panic sell? Your answers to those three questions tell you whether your current allocation is your actual risk tolerance or just the risk tolerance you think you have on a normal day. Step 3. Stop trying to time the market. Set up automatic contributions instead. Nearly 3 in 10 investors say they're actively shifting towards safer investments, while many are sitting on cash and delaying long-term decisions. Analysts note this behavior can actually amplify economic slowdowns. Pulling your money out of the market before a crash sounds smart, except that doing it correctly requires 2 perfectly timed decisions: when to get out and when to get back in. Almost nobody gets both right. The people who got out in February 2020, right before COVID crashed the market, felt like geniuses, until the market recovered 70% in the next 12 months and they missed almost all of it, still sitting in cash. Set up automatic monthly contributions that keep investing regardless of market conditions. This is called dollar cost averaging, and it is the single most proven method for building wealth through volatility. You buy more shares when prices are low, fewer when prices are high, and over time, you come out ahead of the person who tried to be clever about timing. Step 4. Do not look at your portfolio every day. This sounds like soft advice? It isn't. Behavioral finance research is unambiguous on this point. The more frequently investors check their balances during a downturn, the more likely they are to make emotional decisions that permanently damage their returns. Checking your portfolio daily during a crash is the financial equivalent of weighing yourself 10 times a day while on a diet. The fluctuations don't tell you anything useful, but they will absolutely mess with your head. Set a rule for yourself right now, before a crash happens. During any period where the market is down more than 15%, you will check your overall portfolio balance no more than once per month. Everything else you read will be news, which is designed to provoke reaction, not to help you build wealth. Step 5. Do not sell your long-term investments to buy safe assets. When markets drop, the instinct to move into cash, gold, or bonds feels like protection. But for long-term investors, it is actually the most damaging move available. Here's the math that makes this concrete. If you had $100,000 in an S&P 500 index fund in January 2020, right before COVID hit, and the market crashed 34%, your balance dropped to roughly $66,000. If you held through the recovery, by the end of 2020, you had approximately $118,000, more than you started with. If you sold at the bottom and moved to cash, you locked in a $34,000 loss and then had to perfectly time your re-entry to recover. Most people who sell at the bottom never fully re-enter the market. They wait for certainty that never comes, while the market climbs without them. Selling long-term investments during a crash doesn't protect your money. It permanently destroys a portion of it. Step 6. If you have cash, consider investing more, not less. This is the step that separates people who merely survive a crash from people who use it to build serious wealth. Every major market crash in history has been a buying opportunity for anyone with a long enough time horizon. The 2008-2009 crash, the 2020 COVID crash, the 2022 bear market. In every case, the investors who continued buying or increased their buying during the decline came out dramatically ahead of those who held still and astronomically ahead of those who sold. The risk of a significant correction between 15 and 30% is elevated in 2026. A full-scale crash above 40% is less likely without a recession. Even in the correction scenario, an investor who moves an extra $500 a month into a broad index fund during a 20% drawdown and holds for 10 years will look back on that period as one of the best financial decisions of their life. You don't need to be certain the bottom is in. You just need to be buying quality, diversified assets at lower prices than last year. Time does the rest. Step 7. Rebalance your portfolio back to your target allocation. After a major crash, your portfolio's proportions will have shifted. If you started with 80% stocks and 20% bonds, a 30% market decline might leave you at 72% stocks and 28% bonds, because your stock positions fell more than your bond positions. Rebalancing means selling some of the bonds that held their value and buying more of the stocks that dropped, which is exactly the counterintuitive move that most people can't bring themselves to make emotionally, but which the data consistently shows produces better long-term outcomes.
Set a rule. Once per year, or whenever any asset class drifts more than 5% from your target, rebalance. It forces you to buy low and sell high systematically, without requiring you to make any prediction about market direction. Step 8. Check your tax situation for harvesting opportunities. A market downturn creates a specific tax opportunity called tax loss harvesting that most ordinary investors never use. Here's how it works. If you're holding a broad market index fund that's down 25% in a taxable brokerage account, you can sell it, immediately buy a similar but not identical fund, and book the loss on your taxes, which can offset capital gains elsewhere in your portfolio or reduce your taxable income by up to $3,000 per year, with excess losses carried forward indefinitely. This doesn't work in 401k or IRA accounts, only in taxable brokerage accounts. But for anyone who has taxable investments, a crash is one of the most valuable tax events of the year. The IRS is essentially sharing in your loss, which reduces the real cost of holding through the downturn.
Step 9. Revisit your income and increase your savings rate while prices are lower. Post-crash periods often coincide with lower asset prices across the board, not just stocks. Real estate can correct, consumer goods can deflate, interest rates may fall as the Fed responds. The post-crash environment, uncomfortable as it feels, is often the best buying environment available for almost any major asset class. The investors who came out of 2009 and 2020 and 2022 with the strongest positions were the ones who aggressively increased their savings rate during the downturn and deployed that capital into depressed assets.
Here's the summary you can actually use. Before a crash, build your emergency fund. Audit what you own and whether it matches your real risk tolerance, and set up automatic contributions so your emotions can't interrupt your strategy. During a crash, stop checking your balance daily. Do not sell long-term investments into cash or safe assets. And if you have additional capital, consider investing more rather than less. After a crash, rebalance to your target allocation. Harvest tax losses in your taxable accounts, and increase your savings rate to take advantage of lower prices across the board. The S&P 500 has never produced a negative total return over any rolling 20-year period. Every crash ends. The only question is whether you'll be positioned to benefit from the recovery or still sitting in cash, waiting for certainty that never arrives. The best time to build this playbook is not when the market is falling. It's right now, while you still have time to think clearly.